Hello! Today we are going to be discussing the effective interest rate method for bonds that were sold at a premium. The problem says that on January 1st, 2020, Ellison Enterprises issued $100,000 of 10% 7-year bonds. The bonds pay interest semi-annually, meaning twice a year, on June 30th and December 31st. The market rate of interest on the date of issuance was 8%. The bonds were sold at a price of $110,563.12. We are asked in Part 1 to prepare an amortization table using the effective interest method for the first 2 years of the bond's life. And we're going to be doing this over here in this table that I've created. Now, since we're preparing the table for the first 2 years of the bond's life, and these bonds pay interest semi-annually, that means we're going to have 4 interest payments. And that's these 4 periods that I have over here. Now, I also have a period for the issuance of the bonds, which is on January 1st, 2020. And there's not going to be any interest paid, and we don't have any interest expense or any premium amortization, but it's sometimes helpful to fill out the initial balance of the premium and the carrying value of the bonds. So that's what we're going to do right now. So the balance of the premium is going to be the selling price minus the par value of the bonds. So in this case, the selling price is $110,563.12, and we subtract the par value, which is $100,000. And that gives us a balance of the premium of $10,563.12. Now the carrying value always starts out at whatever the price of the bond is. And in this case, that's $110,563.12. So that's what I'm going to type in right here. Alright, the next thing we'll want to do is to calculate the interest payment for the interest paid column. And the way we're going to do that is by taking the par value of $100,000, multiplying by the contract rate of 10%, or 0.1, and then dividing by 2, since these are semi-annual bonds. And when you do that calculation, you will get an interest payment of $5,000. And that's going to be the same for all of the different interest payments, so we can drag that down to the other 3 dates. Alright, the next thing I'll want to do is to find the market rate of interest divided by 2. And if we look closer here, we'll see that the market rate of interest on the date of issuance was 8%. So if we take 8% and we divide by 2, we will get 4%. So everything I've done so far, I consider the setup of the amortization table. Next, we can move to the remaining columns. So first, the interest expense. Now you might be wondering, why should the interest expense be any different than the interest paid? And that's a great question, and one that we're going to explore right now with the use of this picture that I've made. So this picture shows the life of the bond, or the bonds. So first we have the sale of the bond, and that's for $110,563.12. And then we have 7 years of interest payments, since the life of this bond is 7 years. And since the interest payments happen every 6 months, there's going to be 14 interest payments. So we have the first interest payment of $5,000, the second interest payment of $5,000, etc. And I'm not showing every interest payment because that would be a little bit repetitive and the chart would get very long. So this ... is just representing payments 3 through 12. And then eventually we get to the 14th payment at year 7. And then also we have a principal repayment of $100,000. So if we think a little bit about what's going on here, we see that the company is borrowing $110,563.12, but at the end of the bond's life, they only have to pay back the par value, which is $100,000. And the difference between those two numbers is the premium of $10,563.12. So since they're paying back a little bit less than what they borrowed, this premium is actually going to be a reduction in the interest expense. Remember, interest expense can be thought of as the cost of borrowing money, or the cost of using money. So since we have to pay back a little bit less than we borrowed, this is going to be a reduction of the interest expense. And the other part of the interest expense is going to be each of these interest payments. So the way that you could find the total interest expense would be to add up all of these interest payments, so that'd be 5,000 times 14, and then you could subtract the premium of $10,563.12. And that would give you $59,436.88. But we're not going to record that entire interest expense all at once, because accountants are very interested in when revenues and expenses are recorded, and we want to record them in the correct period. So we're going to have to split up that interest expense into each of the different interest payments. Now, one way to do that would be to equally split up that interest expense. So take the $59,436.88, divide that by 14, and record a little bit in each interest payment, an equal amount. And we call that the straight line method of accounting for the interest. Now in this video we're going to be doing a little bit different of a process, and that's called the effective interest method. And that's the reason why we have to make this whole big chart, which is going to help us calculate the interest expense, which is actually going to change each period. But it will still total up to the $59,436.88. And you'll see how that works in just a minute as we complete the rest of this chart. So if we look back at the chart, you'll notice that I've labeled each column with a different letter. So we have A, B, C, D, and E. And then above each column, I've written a formula that's going to help us calculate each of the different balances inside of these cells. So first, let's start with the interest expense. The formula tells us to take the previous balance in column E, which is the carrying value, and then multiply by the market rate, and that should be divided by 2. So if we're in this cell right here, we need to go to the previous value in column E, so that means go up one row and find column E, so that's going to be this value right here, so it's going to be this value, and then we have to multiply that by the market rate of interest divided by 2. And we already found that to be 4%. And if you're typing this into your calculator, that's going to be times 0.04, the decimal form. And if you do that, you'll get the interest expense for the first interest payment to be $4,422.52. So next, for the premium amortization, we need to take the value in column A and subtract the value from column B. So that's exactly what we'll do. We'll take the interest paid, which is column A, and subtract the interest expense, which is column B. Now just note, if you were doing a discount, this would be flipped around, so you'd have to take column B and then subtract column A. Next, we can find the balance of the premium by taking D previous, meaning just the previous value in this same column, which is this $10,563.12, and subtract column C, which is the premium amortization. And that's going to give us $9,985.64. Next, for the carrying value, we can take E previous, meaning the previous value for the carrying value, and subtract column C, which is the premium amortization. Now there's one other way to find the carrying value, and that would be by taking the par value, which is $100,000, and adding the balance of the premium. So $100,000 plus $9,985.64 will also give us $109,985.64. And just note that if you had a discount, then you would find the carrying value by taking the previous balance and adding column C, which would be discount amortization in that case. So now that we've finished the first complete row of the table, let's talk about what the different columns mean. So first, we have interest paid, and that's pretty self-explanatory. The company is paying out $5,000 in cash interest each period. Now the interest expense we talked a little bit about earlier, and that's going to stem from two different places. So first, we start with the interest paid, but then that's going to be reduced by some portion of the premium from that period, which in this case is $577.48. So you can see, if you took the interest paid and you subtracted the premium, you would get the interest expense. The premium amortization is some portion of the balance of the premium that's going to be reduced in that period. So really, this entire balance of the premium is going to be split up amongst the 14 different interest payments. And again, we're only doing the first 2 years of the bond. This table would actually go many more rows here if we were doing all 14 payments. So the balance of the premium is going to be reduced by whatever the premium amortization is, and that's how we get our new balance. And this number is going to continue to get smaller and smaller and smaller until it will eventually hit 0 at the end of the bond's life. And the same thing is going to be for the carrying value. It's going to start at the price of the bond, and then it's going to continue to decrease and decrease and decrease until at the 14th interest payment, or at the end of 7 years, this would eventually reach not 0, but $100,000, because that is the par value of the bond. So now we can complete the rest of the table following the same process that we did for the previous row. So the interest expense, we take the previous balance in column E, and we multiply that by the market rate of interest divided by 2. For the premium amortization, we take column A and we subtract column B. For the balance of the premium, we take the previous balance of the premium and we subtract the premium amortization in column C. And for the carrying value, we take the previous carrying value and we subtract the premium amortization. So now we just have 2 more rows to complete in the table. So what I encourage you to do now is to pause the video and see if you can fill in the values for the last 2 rows. So give that a shot and we'll see you in just a minute with the answers. Alright, we are back with the last 2 rows of the interest table. So maybe take a moment to check your answers and see if you can match the ones that I have here on the screen. So once you've checked that out, we can move on to part 2, which is to record the journal entry for the second interest payment. So I've been hiding some journal paper here, so let me move this out of the way. And we need to record the journal entry for the second interest payment. So if we look over here, the second interest payment is going to be on 12/31/2020. Remember, the first period here was not a payment. This was just kind of setting up the table. So the second interest payment is going to be 12/31/2020. So in order to complete the journal entry, you're going to use the table. And specifically, you're going to want to use the first 3 columns of the table. So first, since we're on 12/31/2020, let's look at the first column, which is interest paid. So when I think paid, I think cash. So the company's paying out cash. And if we're paying out cash, well, cash is decreasing. And cash decreases with a credit. So we're going to have to credit cash. So I'm going to put that on the third line, a credit to cash for $5,000. Next, I'll think about the interest expense. And that's exactly the account name. We're going to use interest expense. And expenses increased with a debit. So that's going to be a debit to interest expense in the amount of $4,399.43. Next, we have the premium amortization. And that's going to be for $600.57. And if you're not sure which side that's going to go on, you can tell right here that I still have to make up some difference on the debit side. So it's going to be $600.57 on the debit side, and the name of that account is the premium on bonds payable. Alright, we are almost done. There's just one more part here. So let's scroll down, and we see number 3 says, assume that the bonds are retired prior to maturity on December 31, 2020 at a call price of 107. We need to prepare the journal entry to record the retirement of these bonds. So this call price of 107 really means 107%, specifically 107% of par value. So what we're going to do is we're going to take the par value, which is 100,000, and we're going to multiply by 1.07 to represent 107%. And if we do that, we're going to get $107,000. So that means the company is paying $107,000 in cash. So we can credit our cash account for $107,000. Now I'm just noticing here I have the wrong date, so this should be 12/31/2020. If we look back down here, we'll see that this was supposed to be December 31st, 2020. Now the next thing you'll want to think about is, well, we are paying off the bonds, so we have to get them off of our accounting books. And the account that's related to the bonds is called bonds payable. And bonds payable is a liability account, so it has a normal credit balance. And so to get rid of it, we're going to have to debit the bonds payable account. And that goes on the books for the par value, which is $100,000. So to get it off of our books, we're going to debit bonds payable for $100,000. The next thing I like to think about is, well, the premium on bonds payable. And along with the bonds also comes either a premium or a discount, depending on which one you have in the problem. In this case, we had a premium on the bonds payable. So if we look back to the chart on 12/31/2020, we see that the current balance of the premium is $9,385.07. So since that's related to the bond and we are calling the bonds or getting rid of the bonds, we're also going to have to close that account. And that account is the same one we used in the last journal entry. It's going to be the premium on bonds payable for $9,385.07. Again, getting that right here from the table. Now if you look back at this journal entry, you'll notice that the total of the debits is a little bit larger than the total of the credits. So that means we have to make up the difference on the credit side. And if you have to make up the difference on the credit side for this part, you're going to call this the gain on retirement of bonds. And if it was the other way around, meaning you had to make up the difference on the debit side, you would call this the loss on retirement of bonds. And the way you're going to find this is you're going to take the sum total of all of the debits and subtract the sum total of all the credits. Well, there's just one, it's the cash at $107,000. and you will get a balance for the gain on retirement of bonds of $2,385.07. Alright, we are finished with all three parts. Now just note, if you are dealing with a bond that has a discount, I've tried to point out some of the differences within this video on how you would deal with the table and the journal entries. But if you'd like to see a full problem worked out, we also have a video for a discount on bonds payable, so make sure to check that out.